Welcome to our new TP Espresso. Today we are talking about how to prepare a year-end adjustment considering the draft EU TP directive. The core message is to apply year-end adjustments consistently and have a proper planning process in place. Let's look into it in more detail. Several multinationals aim to earn a fixed point margin or a margin in a corridor for routine distributing or manufacturing entities. Reaching a target margin will become even more relevant if the OECD Amount B approach is implemented, as it requires a target margin in a small corridor of only 0.5%. Many multinationals are not able to set the prices in a way that the target margins are reached. As such, they need a mechanism at the end of the year to map the actual profit with the target profit. It is called year-end or compensating adjustment. Such adjustments are often challenged by tax authorities. How can this be avoided? Firstly, establishing a written agreement at the beginning of the year that clearly outlines the rules for such adjustments is recommended. Secondly, the TP draft directive provides 5 criteria which need to be fulfilled. The taxpayer tried to reach a target margin. The difference between plan and actual margin can be explained. Adjustments were made symmetrically for all member states. The application was consistent over time. And the adjustments were made before filing of the tax return. Even if not legally binding, I would recommend following these principles already today and steer it by a clear process. But transfer pricing is not the only consideration regarding year-end adjustments. 2 very interesting court decisions have been published dealing with customs aspects. In a nutshell, lump sum adjustments shall not result in a refund of customs payments, but shall also not result in additional customs duties. The details of the decisions and if customs officers follow them in practice are something for another espresso. Have a good one. Cheers.